Hey guys, welcome to the second video on the channel. In today's video, it'll be a part 2, a continuation of Robinhood tutorial about options. So what are options, how do you profit off of options, and why do you want to get into options, right? You see a lot of difficult terms to understand, you're confused, you can't find a helpful video, well, you come to the right place. So according to Google, an option, it gives the investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and date. So essentially, there are two types of options. You have a call. You have a call and a put. So when you buy a call, you're expecting that the company stock will rise up and pass a certain threshold that you'll pick. Later on in the video, I'll show you how. And the put is its counterpart. If a company goes down a certain mark that you pick, you make profit. So yeah, that's pretty much a simple thing. Simple term, call and a put. Call goes up, put goes down. So when you buy a option, there's a thing called a contract, which is you're agreeing to buy, when you buy an option, 100 shares of a certain company. But you're not actually buying 100 shares of the company. You're buying a contract, which is telling that you apparently own 100 shares of a company for that certain time frame that you set. Because the thing with options is that there's time decay. So there's time decay, and the sooner the dates go by, right, and your expiration date is right here, the less profit you make. You should never wait till expiration date to sell your stock. You should sell it before expiration date so you can get the most out of it. But yeah, so 100 shares is one contract. We'll just abbreviate contract, right? So how do you make profit off of this, right? If you buy one contract, which is 100 shares, for, let's say, 1 cent, right? So you bought 100 shares for 1 cent for each share. Essentially, that's equal to $1. So you paid $1. You paid $1 for 100 shares of a certain company, XYZ, whatever. And then XYZ company, you bought a call for XYZ. Yeah, let's do that. You bought a call for XYZ for $1. And you currently own 100 shares of that company now for, let's say, May 22nd, and it's May 20th, or you have a week or whatever. You own that. And then tomorrow, the stock went up in price from 1 cent to 2 cents. So now, if you were to sell this contract before expiration date, you would make $2. You made $2 because now, instead of 1 cent, it's 2 cents. And you multiply 100 shares times 2, and you get $2. There you go, $2. You made $1 profit, 100% return, because you bought a call and the company went up. But if it was the opposite, you bought a call and the company went down and is now less than a cent, it's 0.005, half of a cent, and the expiration hits, well, you lost all your profits. That's why you never wait till the last day or expiration date to sell your option or contract. You should sell it beforehand, because there's too much volatility. You lose time. You lose time, and you lose value on your stock because of time decay. So time decay, bad. You should sell it beforehand. So if we go here on the Robinhood app, right, you click this stock you want to buy. For example, you want to buy pharmaceuticals, because you've been hearing good news about them. Then you click trade options. You buy options. Now you click buy, not sell, because you don't have 100 shares of the company. So that'll be in another video. So you click buy. You want to buy a call, not a put. Call up, put down. So you want to buy a call, right? And the share price currently is $13.71 and it's fluctuating, right? So I recommend before buying a call, buy before market opens, like Saturday and Sunday when the market is closed, or right before Monday, like 30 minutes before market opens. Just don't buy it, on market open, because a bunch of stuff will fluctuate. It can go down really quick and go up, too much volatility. So you buy, let's say it looks interesting, and you buy this one right here. So it's a strike price of $9, and your break even is $13.75. You don't know what that means. So your stock right now is $13.71, right? If the stock goes to $13.75, $13.75, you would break even. You would not make any money, but you wouldn't lose any money, right? And the percentage it needs to stand is 7.95%. And the change is roughly around 1370. I lost it. Yeah, 1335%, 0.35 cents, whatever. And you see here the price is $4.75. So you're paying $4.75 for each share, right? So if I were to click here, so if you click here, right, the break-even price is the strike price plus the price of the stock of each individual stock that you buy, and that's the break-even price. So 9 plus 4.75 is 13.75. And the thing with buying options is that it can go both ways. It's really risky, but you can get massive returns, massive profit, but you can also lose a lot. So just be wary. If you're beginning to invest, I don't recommend going into options. Well, if you're trying to grow your account and money's not an issue for you, well, by all means, try it. But be wary. It can cost you a lot. I made $100 off of options and then lost 85 of it because I bought a risky call. So there's different terms that you have to know. For example, if you buy this right here and you sell it, you'll be making $1 profit because this is in the money. So if you see right now, the share price went up to $13.76 and the break even is $13.75. So it's an extra cent. It's in the money. If you were to buy, out the money, this would be a perfect example. Let's see. If we buy this, $13.80 for $7.30 for each share, you would be out of the money because it's at $13.76. So you start off losing on money. But you pick your expiration date up here. You click. You get all these dates. You want to pick between 2 to 3 weeks. If you want to do it long term, you can do that as well. But me personally, I like to keep it between 2 or 3 weeks. I've tried doing 1 week, but it's just too much chaos and it's too quick and just too much time decay too quickly. And a lot of stuff can happen in between, like 1 week. You can have a bad earnings call. Don't trade options during earnings calls. I don't recommend. So yeah, that's pretty much how you trade options. And yeah, see you in the next one.